So let's talk about the $1 million question. This is the question that I get every week, sometimes every day, and that is the market overvalued? Are we heading for a correction? Are we paying too much for the market? So this is a valid question. If we look back to the housing crisis, the bottom of the market was 2009. We're up over 3 times that amount. So we've definitely had a great run. And the question is have we kind of swung the pendulum too far? And are we due for a correction? So let's talk a little bit about that. To be clear, there are 2 primary elements that move the markets, and those are the fundamental elements and the emotional elements. So fundamental are all the good quality things that would move the market for cause. And so things like, are we selling more stuff? Are we earning more profits? All of those good quality metrics, those are the fundamental things that can move the market. Obviously, if profits are going up, so should the price of stocks. And so those are all quality fundamentals. The other element that moves the market is just pure emotions, which tend to not have as much of a reason. They just tend to be moved by fear and greed based on whatever people feel at the time. And so we can see this take place in the big markets, which are kind of hard to understand sometimes, but we can also see it in a more understandable item. Like, let's take the recent phenomenon of fidget spinners, right? Fidget spinners have all of a sudden become this big deal. And if you think about it, when they first came out, they were about $2. And then all of a sudden they became popular and they started selling out and they were hard to find, and you'd go into stores and you'd see them and they were $10 and $15 and $20. Why did they go from $2 to $20? Is it because the plastic and the ball bearings and all the pieces that make up fidget spinners became more expensive and harder to access? No, it was just pure emotion. All of a sudden they realized that the emotions were high, everybody had to have them, and so they could sell these things for a lot more money. And the same thing will happen in stocks. When stocks become all the craze and everybody wants to have stocks, it will drive the prices up, and then when that emotion fades and everybody starts to get fearful, it'll push the prices down. So we really want to focus more on fundamentals and make sure that what we're paying for stocks is closer to the fundamental value and not get us wrapped up in that emotional side. So how can we identify that? How can we look at the market and tell where we stand? Well, a really simple way to do that, one of the key metrics that we would look at is what's called a PE ratio. You've probably heard of this term before. It stands for price to earnings ratio. And so we're saying, what multiple of earnings or profit are we trading this stock at? And so you can go to Google Finance, you can look up a stock and you can see what is the earnings per share. So let's say the earnings per share are $1, and they're looking primarily at like a whole year's worth of earnings. And the long-term average for stocks across the market, now every stock's a little different, but if we look at the average of all the stocks across the market, the long-term average for a PE is about the 15 to 17 range. So what they're saying is if a stock is earning $1 a share, it should fundamentally trade somewhere around $15 to $17. If you look at today's PE ratios across the market, they're actually in the mid-20s. So stocks are trading, with $1 of earnings, they're trading at, maybe 25 a share, which looks like it's really high, right? If long-term averages should be 15 to 17, it's trading at 25, that does look like it's a bubble type of market, and it could correct back to that long-term average of 15 to 17. And surely we don't want to pay at 25 if it goes to 17, or we don't want to keep holding it at 25 if it's going to go to 17. But why might that not be the whole story? Why might that be, not as bad as it could be? And the reason is because we have to look at the alternatives. The alternatives right now are bonds. And without going into a lot of detail there, bonds are kind of in a bad spot right now. They're not paying a lot of interest. And they're just in a really weird spot. And so a lot of big money, what I mean by big money is the banks and the insurance companies and the pension funds. These big money dollars are not, they're really worried about bonds right now. And so they're willing to put up with stocks a little bit longer and they're willing to pay a little bit more for stocks because the alternative is bonds. They really don't like bonds. And so even though the market's a little overvalued historically, it doesn't really look like it's fundamentally a wreck. And so that's really the main thing we want to look at is this just a pure, if we look back in the 1990s, when the tech bubble was rolling up. Here were companies that weren't even making a profit. They weren't even earning profit. They were selling at $100 a share. So that's really a fundamental mess. Today we have companies earning profits. They're making money, and they're just trading a little bit higher than average. But that's really because of what's going on in the bond market. So what do you do about this? Now that you understand that, how do you respond? What do you do if you're an investor? Well, there's really two things you need to focus on. One, you need to be diversified. Don't take targeted bets right now. Don't go into it and say, I'm going to go all in on this one company or this one stock. Have a diversified portfolio that represents a lot of different types of markets. In other words, domestic, international, emerging markets, small companies, large companies, all types. Have diversification. And then the other thing is I believe right now is a good time to lean towards active management versus passive. So passive management is indexing, is where you just buy the index and you just ride the market. Well, today, being that we have to unwind kind of this place where we are, maybe a little bit overvalued in stocks, I believe it's better to have someone actively at the wheel watching over those investments and making some of those shifts on your behalf. And so there's this whole debate, is active worth it? Do they, the extra fee, does it justify what they're doing? I don't believe that's an answer that is absolute all the time. I think that in certain markets, it's worth it having someone giving a real shot at beating the market. And then other times it's worth just indexing. I think today we're in a market where having an active approach probably makes a little bit more sense. And so be diversified, be a little more active, or have an active manager approach. And I think that will position you in the best way to get ready for this unwinding of where we stand in the market right now.